Good morning and welcome to this Monday, April 13th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, before I get into everything today, I do want to just say that it has been a wild night here in South Carolina, close to the Charlotte area. We've had tremendous storms go through, as many of you I'm sure are aware. Those of you living in the South and on the East either experienced it yesterday or probably experiencing it this morning, maybe even right now. But lots of really wicked storms going through, lots of tornadoes and so forth. I know my daughter's out of power in Charlotte. I was pretty fortunate to keep my power. My partner, John Hopkins, his son, are in the Charleston area. I think they're getting prepared right now for quite the storm activity under a tornado watch and so forth. So things have been pretty crazy. So if you were trying to get into the room this morning, I know our Earnings Beats Digest newsletter, I'm not sure if it's gone out yet, but it was ready to go out. But because of the storms, things kind of been in a little bit in a shambles this morning. So that will be going out at some point if it hasn't already. But just wanted to let you know that that is still in the process of going out. Also, before we get into things, I just want to remind you that tomorrow, Tuesday, we will be doing our regular Max Pain session that we do the Tuesday before options expire. And options expire the third Friday of every month. So tomorrow will be our April Max Pain webinar. So make sure you put that on your calendar. I believe it'll be shortly. I don't know if it's going to be 4:30 or 5 o'clock, what the scheduled time is, but we'll keep you posted on that, let you know when that's going to get started, but wanted to make sure you were aware of that. This is going to be an interesting month because of the huge movement. Of course, we had the big sell-off in the market. Now we've seen some rebound. Earlier in April, we pulled back a little bit. Now we're on rally. As far as futures over the weekend and last night, it looked like it was going to be a pretty rough start to the action today, and may still be. We still have another 28 minutes to go, so who knows what's going to happen, right? But currently, I was just looking at the spider here just a second ago. Spider's only down about 1/4 of 1%. It was down well over 1% overnight. I know at one point the Dow futures were down like 350. I'm not sure exactly how low they got, but I think at one point it was 350 points. Looking at the QQQ this morning, we're seeing that also down about 1/4%. So at least to get started this morning, looks like maybe just a little bit of red. But with options expiring this week and with the huge rally and this unprecedented drop because of the coronavirus, the rest of this week could get really interesting in terms of the volatility. So we'll take a more specific look at that tomorrow after the market closes in our Max Pain webinar. So be ready for that. Okay, looking at the market from Friday, the Dow Jones Industrial Average was up a little more than 1%, rose almost 300 points. The S&P 500 up nearly 1.5%, NASDAQ up 0.75%. But mid caps and small caps really had a big day on Friday. I don't know if you saw it, but mid caps up 3.3%, small caps up more than 5%. So we're seeing a huge rally, and in particular, the small cap index you can see down here on the accumulation distribution. And I would prefer looking at the ETFs because a lot of times the opening price on an index isn't really representative of where that index opened because a lot of stocks won't open until a few seconds after the opening bell. So when you're looking at accumulation distribution, which relies a lot on that opening price, if it's not a true opening price, it can mislead you a little bit on the accumulation distribution. So for instance, on the Dow, I would tend to focus more on the diamonds, DIA, for the S&P 500. Look at the SPY, NASDAQ or NASDAQ 100, check out the QQQ. And then for the small cap index, I would look at the IWM. That would probably be a better indication. But still, I think it's worth noting, even on the index, that we are breaking to a new accumulation distribution high, or we did break to it on Friday, even though you can see price actions way below. So this continues to support my belief that there is still a lot of accumulation taking place in the market, even though we've been through this mess. I'm not a believer that we're going to go straight back up V fashion. I just think that, and I even think later this week, again, we've got options expiration, but we got a lot of economic reports coming out starting on Wednesday. And that, I think Wednesday is going to be a key, because when I was looking forward to see what kind of economic reports are coming out, we've got retail sales coming out on Wednesday. That ought to be an interesting report. Industrial production, capacity utilization, business inventory is probably not so much that one. Housing market index will be out. Also, the Beige Book comes out Wednesday at 2 p.m. So 2 weeks before a Fed meeting, you have one of the Federal Reserve districts that comes out with economic evidence of what's taking place. You can imagine 2 weeks before the Fed meeting, one of these Fed Reserve districts, what they might have to say about the way things are shaping up. So I think the Beige Book on Wednesday at 2 o'clock may carry a bit more significance than it ordinarily would. And then also in the morning, there's an Empire State Manufacturing Survey. If you're not familiar with this, the New York Fed conducts a monthly survey of New York manufacturers. It's on the first of each month, and they go back to the same 200 manufacturing executives, which typically are presidents or CEOs, and they send them a questionnaire. The same 200 get this questionnaire at the beginning of every month to report changes in an assortment of indicators from the prior month. And then they also give their view about the likely direction of these same indicators in the next 6 months. So the Empire State Manufacturing Survey, which maybe you look at, maybe you don't, I think that's one that's going to be especially important given what's taken place in New York over the course of the last 30 days. So I think Wednesday is going to be a really big day for the market, because you've got all this activity, all of the interest building as you get closer and closer to options expiration. A lot of economic reports coming out, which we know are not going to be very good. Has the market already digested that and is rallying in the face of it? Or is this going to be a little bit of a sticker shock kind of a thing, where the market is finally going to start to say, whoa, wow, didn't realize it was going to take that kind of toll? I don't know which way it's going to go. I do think that the rally was to be expected. I mean, it's a rubber band rally. Anytime you get the market that goes straight down like we've seen here in 2020, you get a bounce. We saw it in 2008. We saw it in 1987. Those two were kind of capped off by about that 38.2% to 50% Fibonacci retracement levels. On Friday, we were right there at that 50% Fibonacci retracement level. So this is an area where we could see a reversal. I sent out an email to members on Friday. I said, listen, if you like, I kept saying all along during this rally to have patience. If you want to short or you want to do the leveraged ETF, have patience. You could start to build a position when we hit 38.2, but you want to be prepared in the event that we get to the 50. Well, we hit that 50 on Friday. So that's why I said, hey, if you want to short, having the patience for the last couple of weeks and allowing this market to rebound, I think this is the best reward to risk time to get into those inverse ETFs. Again, I'm not saying that we're going lower, because I've seen the market do some crazy things in my time. And I believe we're in a secular bull market. So anytime you're betting against a secular bull market, in my opinion, you're taking on more risk than you probably should. However, to think that we're not going to have some kind of another move to the downside, I think probably would maybe be a little bit irresponsible. I think at some point we're going to pull back, and this would be a level. So anyway, just wanted to go through all of that. I do think there's a lot of stuff happening this week. This is going to be crazy. And again, if you're in the South last night or in the Southeast, now up the East Coast today, you're going to see more crazy in terms of weather, because those storms last night were fierce. I haven't seen anything quite like that in a while. I swore I thought we were going to have some trees coming through our house in the middle of the night around 5 o'clock. Okay, let's keep moving on here. 10-year Treasury yield. Let me give you an update here. I didn't go through the other sectors, but you can see down here. These were all the groups. These four were the best groups on Friday: financials, real estate, utilities, materials. You don't see any of the aggressive areas other than financials that did well on Friday. So it's kind of a mixed picture. It's nice to see the rally, but where's our aggressive groups? Not really to be found there. To the downside, the only sector I think that saw any kind of selling on Friday was energy. And I'm going to pull this chart up for you real quick. Filled candle, we did get back up and test. See how we gapped down and had a reaction high around 36 or so? We tested that level on Friday and reversed off of it. I think closing above 36 to 36 and a half is kind of a big deal for XLE. I know we still got the 50-day above. We got this other gap up here to fill. But when you get a big gap down like this with massive volume and you can only get back up to 36 and change, that's going to be a level that's going to be really important technically to try to get through, because that's where all the sellers were back in the second week of March. That's where I would expect sellers to show up again, and they did on Friday. Can we get through? I would guess no. I would think at least we're going to have to go back and test that 20-day moving average, would be my guess. And if we break below the 20-day moving average, and that's what I'm going to be looking for on a lot of different areas of the market, if we break below the 20, that's potentially going to set us up for some additional selling. More technical sellers, I think, would jump on board if we lose that 20-day moving average. 10-year Treasury yield right now, get that update. It is currently at 0.752, so roughly 0.75%. Last week talked about trying to get through this this 0.75 to 0.80 level. I think this is a key area because, again, if you're looking for a big move higher or continuing push higher in equities, we want to see money rotating from the defensive Treasury area to support that move to the upside. And so far, we haven't seen it. Also, off of this short-term uptrend, we gapped up. Right now, we've kind of got this consolidation. This is an island cluster, potentially. So if we stay in this area between, let's just call it 0.70 and 0.80, something like that. I think if we stay in this area for the next couple of days with all those economic reports that come out on Wednesday, if the bond market doesn't like that, and we see a lot of folks, beginning to panic again, jumping into treasuries, we could see a gap down, which would then mark this island reversal top. And if that happens and we see the treasury yield going down, that to me would be an indication that we've probably got more pain coming in the equity market. So that would be something to watch very closely. And another reason why all these reports on Wednesday, I think, are going to be very, very important. So we'll keep an eye on that for sure. Let's see, what else do we have? Let's move on into talking technically. One of the things I wanted to do, let me see if I can find the chart. See, I had limited time to get ready for this morning. So it's going to be kind of looking for things I want to talk about, but I wanted to go in. Well, this was the 2008 Fibonacci. So just to give you an idea, I talked about the 38.2 to 50% level. Here, you can see the big move down. Here was, now the initial move up came up in 2 days, and then we went right back down. So the panic came in. We didn't really stabilize over 2 weeks or 3 weeks like we have this time. Once we went back down, then we did stabilize. I mean, the entire period of sideways consolidation did span probably 3 or 4 weeks before the selling resumed to the downside. But the initial bounce only took 2 days. And if you remember, our initial bounce that we had was 3 days currently. So let me show you the S&P 500 currently. See, here was that initial 3 days. So that's kind of what we were just looking at on this 2-day recovery. Back to the 50% level from the low to the high took 2 days. Well, this time it took 3. And it only got us to about the 38.2. So if I annotate this, this will be just roughly. But right there, you can see 3 days, we got up close to that 38.2, started to roll over. But the good news was this year, we didn't go all the way back down to hit that double bottom. And then we rallied to another high. Now, is this the primary trend? And this is an A, B, C correction? Or do we still have the long term? Let me get out of here and show you the long term. If we look at a weekly, probably even need to go back to a monthly. And you can't really see the ABC on the monthly, but we got a long-term uptrend, and this could be an ABC. And the ABC on the daily chart would be A, B, C. Now, normally you don't get that kind of a down move with a C. And I'm not an Elliott wave person, so I'm kind of dangerous when I start talking about waves. So if you are an Elliott wave person, I apologize if I'm offending you with my my own interpretation, because this is not really something I study that closely. Maybe there's a 1, 2, 3, 4, 5, 1, 2, 3, 4, and the 5 move to the downside. Maybe you could count that. And maybe, so that could be the end of the down move. And now we're starting to rebound back off of it. Hard to say. But I'm sure Elliott Wave folks have a lot of different counts to look at with all the volatility that we've seen of late. Okay, let's take a look at gold. Now, gold last week finally cleared that 1700 level, and it did it with gusto, finishing up at 1752. I saw it was down this morning. I think the last time I looked, it was down about $17 per ounce. So from 1752, maybe back down to about 1735 is where I looked this morning. But the breakout level came just around that 1700 area. So a normal pullback would be 1700. If it did fail to hold 1700, I'd watch this rising 20-day. I would expect gold to bounce off of that, especially if the overall market's weak and we're still in this period of volatility and fear. Then I would expect gold to continue to perform well. This is, I don't think this is any kind of a paradigm shift. Some might think this is a big thing for gold going forward. I don't believe it is. I think we're in a secular bull market in equities, which is generally not a good time to be in gold. But anytime you're in a fearful period, gold does well. And we're certainly in a fearful period. I don't know that we're quite out of that. So that's why I think in the short term, gold, the way it's continuing to trade, I'd be fine with it. Just if it starts to break down, keep that in mind, that if it breaks down, chances are it's because the stock market is starting to look more, better and better technically. And that could be a bad sign for gold. How about crude oil? Let's take a look at crude oil. Now, we did have an unprecedented cut in production from OPEC announced over the weekend. And so you can see that we were moving back down 22.5. Let me give you the latest on crude oil. Currently, it is, I'm showing just up 6 cents to 22.82 per barrel. Make sure I got the latest here. The S&P, by the way, still down about 0.25% as we approach the open. Oil showing up 29 cents now. So it's a little up a little over 1%, 1.25%. It is currently at 23.05. So it's getting a little bit of a boost from the cut in production. I'm going to say that the market at this point is thinking that probably it wasn't enough, that probably needed even a bigger cut, because we're probably not going to see demand pick up anytime soon. I don't know if you've been out much, probably not, because not a whole lot of folks driving right now. But gas prices are down. I mean, in my area, I saw as low as $1.55 a gallon here in South Carolina. And, I've always told people, somebody will come in and they mention to me, they know I talk and write about the stock market all the time. But, they'll come in and say, wow, gas prices are down or something. This was, months ago when gas would dip 10, 20 cents or whatever. And in our area, get down to maybe 2.10 or something like that. They'd come in and be excited because gas is dropping. And I just always would remind them that, you're probably saving a couple of bucks in your tank of gas, and you're probably losing a couple grand or a few grand in your retirement. Because the direction of oil prices and many times gas prices is a reflection of demand. I mean, it's also supply, but a lot of times it's demand. And when demand is down, it's not a good sign for the stock market, because if global demand is down for oil, chances are it's down for a lot of things. And as a result, you get a drop in the stock market. So careful what you wish for in terms of low gas prices, because anybody who wanted really low gas prices is getting them now. But if you're invested in the stock market, I don't know that it's worth it. I'd rather pay a little bit higher gas price. All right, next up, how about, overnight, the Nikkei was down 2.3%. So that's not reflected here, but it was down, I think it was down somewhere around 450 points or something like that. I can actually give you that number. 455 points to 19,043. So it is right back down on its 20-day moving average, or very close. The 20 days coming in just under 19,000. So we got this double top here on the Nikkei, and we're pulling back to the 20-day. If we can't get that breakout, that would be a little bit of a negative for global markets, because that failure at that initial reaction high probably wouldn't be a great thing for markets. Now, the one market that we follow most closely is the German DAX. I mean, when we look around the globe, and right now the DAX is up 2.25% this morning. So let me see here. So the DAX was up to 10,000. Actually, no, this was as of last week. I'm not sure if they're closed for Easter Monday. That's a good question. I know there are some markets. I know Australia is closed for Easter Monday. I'm not sure. I hadn't even looked to see if Germany is down. But what they're showing in Germany is basically the same close that we had from last week. So maybe Germany is closed. That's probably something I should have looked at this morning. But Germany, you can see, did take out that prior high. So we've got the move down. We got very similar to what we've seen in the S&P 500. The rally back to the 20, failure, looked like we were rolling over, and then another surge to the upside. So I think we've got a lot of overhead resistance. We've got the 50-day moving average. And if I annotate Germany and we look at this from a Fibonacci perspective, and it's not perfect, but somewhere right around here, you can see that Germany has moved above 38.2 and is into this 38.2 to 50% level. One other thing I'll show you on the Fibonacci. Let's go back to the S&P 500. And actually, let me see, before I try to go back and set this chart up, maybe I already have it. Yeah. All right, let me, I'll pull it up. I can't find it on here. I just want to go back and show you, if you haven't seen it, what it looks like back in 1987. So if we go 1987 and we go to 1988, all right, and now let's annotate this. And I could start from all the way back here, but I think the market was kind of stable. I think this is where we had the major drop. And so this is where I really want to annotate from. But you can see again here, roughly, when we hit the bottom, in the case of 1987, we hit that 38.2% in one day. So in 1987, it was one day back to the 38.2% level. In 2008, it was 2 days. And in 2020, it was 3 days to get that bounce. But that marks a significant bottom. Once you get that kind of movement back to the upside, you can see that actually held. We got back close to the bottom a couple months later. And this is, I don't know if we'll play out exactly like this, but I wouldn't be surprised to see, the market, we've come back up above that reaction high, which we did not do in 1987. We couldn't get through that initially. We ended up rolling back over, getting close to the bottom. Came back up, tested it, pulled back again, and then that's where we began rallying in 1987. In 2008, get back out of this. And then in 2008, you can see we came back, we rallied, came back down again, bottom, double bottom, rallied, couldn't get through, and then rolled over again. So in both 1987 and in 2008, you can see that the initial pullback and then these rallies back up into the 38.2 to 50% level, this is what's been, or this is what in the past has been a key range as we've gone forward. So I think that this is going to be an area that we're going to continue to want to watch. And like I said, this week, given that we're already back at that 50% level, I think it's going to tell us a little bit of something about this, what we can expect going forward. I think if we can make our way all the way back to the 61.8% level, or better yet, even break above that, I think that's going to be completely different than what we saw back in the last two significant drops like this, the 1/3 and 20-day kind of drop. And so that would start to paint a picture to me more of a, I don't know if we'd see V bottom, all the way back to the top, but it would begin to tell me, hey, we're in a secular bull market. Don't count this bull market out. And even though, the next couple months will probably be pretty choppy, I do think we're going to, and even if we don't get to the 61.8% level, I think we're going to be choppy and then we're going to go higher. Most of the things that I look at point to that, including just that long-term chart to begin with, very similar to what we saw in 1987. If I go back and we take a look at some of these, was it this one, the long-term chart that I had up? Now, I could probably take this one and just take it back. Let's go monthly and we'll go back 50 years. I mean, if you look at this, you can see 1987. Here's 1987. There's the crash. That's what we just went through, the same thing. But you see it's in a secular bull market where we had broken out above the 1970s and it started moving higher. Here we broke above the 2000s and started moving higher. And now here's that bear market, cyclical bear in a secular bull, cyclical bear in a secular bull. See how we reacted back? This in 2008 was part of a sideways consolidation. This was still part of the secular bear market. So I'm thinking this is going to look more like this than it will 2008. I think we're going to look more like 1987. So we're going to probably, maybe we struggle. Maybe it's, in the case of 1987, we broke out 2 years later, maybe a year and a half later, year and a half to 2 years. That would, put us on course maybe sometime in 2021 or 2022 breaking out. This is a little different with this pandemic because it's likely to be here and then gone. Whether it's going to be 6 months, a year, year and a half, really hard to say at this point. I think that's the primary uncertainty is the timing of it. But I do believe that a year and a half from now, we're going to be looking at this in our rearview mirror. So at what point does the stock market see this coming to an end? And when the stock market sees it coming to an end, it's going to be before you and I see it coming to an end. That's why I think the stock market is going to break out before we actually see the light at the end of the tunnel in terms of the virus. All right, a couple more things before we wrap up here. Let me just say we've got earnings season coming out, a couple of earnings reports, one coming out tomorrow. I'll give you a look at what I see in these couple of earnings reports that are a couple of big ones tomorrow. Johnson & Johnson setting a new accumulation distribution high. And if we go into the relative chart, you can see that this has been a stock that's been performing pretty well on a relative basis. Also strong accumulation distribution. I think we're going to see a decent report out of Johnson & Johnson relative to, say, JP Morgan. JP Morgan has broken out, but when you look at it, it's a good stock within the banks, but the banks have been horrible. So it's one of your leaders in banks. That should be maybe give you a little bit of comfort. When we look at the accumulation distribution, however, it has been going lower. Just a couple weeks ago, it was at a 52-week low. That's a little different than what we're seeing with some of the other charts that we've been looking at. And then finally, Wells Fargo will be reporting. Look at the accumulation distribution here. And even though this one is breaking out, if you look at it on a relative basis, a little different picture than JP Morgan. Wells Fargo has been drifting lower versus the banks. So you got really three different big reports to look for tomorrow. I think Johnson & Johnson being part of healthcare, doing better on an accumulation distribution basis. I think that one would be the strongest of the three if I had to pick. JP Morgan and Wells Fargo, two banks going in different directions relative to their peers. I think they're both probably in a little bit of trouble just because of their industry group. This is a tough time for banks with the 10-year treasury yield where it is. But JP Morgan, from Wall Street's perspective, is handling it better than Wells Fargo. So that's something to keep an eye on as we go into earnings. I would suspect that the market will react better to JP Morgan than we're going to see with Wells Fargo. But again, that's just pure speculation based on what I'm seeing on the chart. All right, last thing, three you must see. I didn't really have time to look at this, but what I would say is let's just take a look at the Scooter reports. And if you just take a look at the top scooter ranked stocks, large cap, mid cap, and small cap, probably going to give you some good ideas about trading. Regeneron, you can see holding up today, up another $1, 5.14. This has been a great performer. Look at the accumulation distribution there. So that would be one to keep an eye on. Moderna, which is also another stock that's doing pretty well as a result of the virus. This is a stock working very closely with government officials on trying to come up with a vaccine. The accumulation distribution doesn't look as good here. It did have a surge in early March, pulled back, starting to strengthen again. Breakout above 36 would be very bullish. And then the last one is CCXI. And this one I'm not familiar with, but you can see accumulation distribution very strong, even though the stock is not at highs. So these are the types of stocks that I would be keeping an eye on as we go forward. All right, that is it. Let me give you a quick update on the market. You can see right now Dow Jones down 113, the S&P 500 down 13, NASDAQ down 24. And don't forget, options are expiring this Friday. If for some reason you're not a member of Earnings Beats, you're not aware of it, we do have a Max Pain webinar tomorrow after the market closes. You do need to be a member though, so go in and check out. We've got a 30-day, $7 30-day trial, and the $7 is fully refundable. So we will give you your $7 back within, I don't know, 5-7 business days or something. So technically it's a $0 trial for 30 days, and you can come in and join us for that webinar tomorrow. So with that, I'm going to go ahead and wrap up. Wishing everybody a happy trading day. Be safe if you're in the line of these tornadoes. It is nothing to take for granted. Trust me. I couldn't sleep through it. I thought we were going to get a tree through our window. So prayers to those in the line of these storms, and everybody have a good day. Be back tomorrow. Take care.